Hi students, welcome back to Google Classroom, Sri Gokulam Public School, Guruvayur. How are you children? Hope you all are fine over there.
Today we will start a new chapter, that is Chapter 8, Sources of Business Finance. We all know that every business requires some amount of money to start and run the business. Whether it is a small business or large, manufacturing business or trading business, money is an essential requirement for every activity. Money required for any activity is known as finance. So, the term business finance refers to capital funds and credit funds invested in the business. Capital funds means owner's funds and credit funds means borrowed funds. Both are invested in the business and it can be called business finance. So, the business finance includes all those activities which are relevant to raising and managing funds required for conducting business operations smoothly. From this, we can understand finance is a major function of any business enterprise. And we know that no one can start a business or run an enterprise without adequate funds. Every business requires some money to start, which is called initial capital. And the initial capital contributed by the entrepreneur is not always sufficient to take care of all financial requirements of the business. Therefore, a business person has to look for different other sources from where the need for funds can be met. So, a clear assessment of the financial needs and identification of various sources of finance are a significant aspects of running a business organization. Now, let's discuss the importance of business finance. The first one is meeting preliminary expenses. Finance is required to meet preliminary expenses. Do you know what is preliminary expenses? Preliminary expenses are those expenses which are incurred before the commencement of business. In some cases, the amount of preliminary expenses tends to be quite high. For example, in company form of business organization. And the next one is meeting fixed capital requirements. In order to start business, funds are required to purchase fixed assets like land and building, plant and machinery, furniture and fixtures, etc. This is known as fixed capital requirements of the enterprise. The funds required in fixed assets remain invested in the business for a long period of time. Besides these, different business units need varying amount of fixed capital depending on various factors such as the nature of business, etc. For example, a trading concern may require small amount of fixed capital as compared to a manufacturing concern. So, these are the main factors related to fixed capital requirements. And the next one is meeting working capital requirements. Working capital requirements are for maintaining appropriate level of inventory of raw materials, bill receivables, and for meeting current expenses like salaries, wages, taxes, rent, etc. The amount of working capital required varies from one business concern to another depending on various factors. For example, a business unit selling goods on credit or having a slow sales turnover would require more working capital as compared to a concern selling its goods and services on cash basis or having a speedier turnover. So these are the various financial needs of a business organization. From all these, we can understand every business activity, money is an important as well as essential component. And you can see that there are mainly different sources of funds. However, the scope of using various sources depends on the type of business organization. In the case of sole proprietorship, partnership, and joint Hindu family business, funds are raised from owners in the form of capital contribution and loans from friends and commercial banks. And in the case of cooperative society, funds are raised from members in the form of capital contribution and loans from financial institutions and banks. However, in the case of company form of organization, different sources of business finance which are available may be categorized into three bases. The first one is on the basis of period, and the next one is on the basis of ownership, and the last one is on the basis of source of generation. Now let's discuss each of these bases in detail. And the first one is period basis. On the basis of period, the different sources of funds can be categorized into three parts. They are long-term sources, medium-term sources, and short-term sources. Then what is long-term sources? The long-term sources fulfill the financial requirements of an enterprise for a period exceeding 5 years. And it includes sources such as shares and debentures, long-term borrowings, loans from financial institutions, etc. And these funds generally required for acquisition of fixed assets such as furniture and fixtures, plant and machinery, etc. Then, what is medium-term sources? The funds are required for a period of more than 1 year but less than 5 years. In such a cases, medium-term sources of finance are used. These sources include borrowings from commercial banks, public deposits, lease financing, loans from financial institutions, etc. And the next one is short-term sources. Short-term funds are those which are required for a period not exceeding 1 year. Trade credit, loans from commercial banks, and commercial paper are some of the examples of the sources that provide funds for short duration. Short-term financing is most common for financing of current assets such as accounts receivable and inventories. Next, we will move on to the next basis, that is ownership basis. On the basis of ownership, the sources of funds can be classified into two parts. They are owners' funds and borrowed funds. Then, what is owners' funds? Owners' funds means funds that are provided by the owners of an enterprise, which may be a sole trader or partners or shareholders of the company. The owner's capital remains invested in the business for a long duration and it is not required to be refunded during the life period of the business. For example, issue of equity shares and retained earnings. And the next one is borrowed funds. Borrowed fund refers to funds raised through loans or borrowings. The sources for raising borrowed funds include loans from commercial banks, loans from financial institutions, issue of debentures, public deposits, trade credits, etc. These sources provide funds for a specified period on certain terms and conditions and have to be repaid after the expiry of that period. Besides these, a fixed rate of interest is paid by the borrowers on these funds. Generally, borrowed funds are provided on the security of some fixed assets. So, these are the main features of borrowed funds. Now we will move on to the next basis, that is generation basis. On the basis of generation, the sources of funds can be classified into two parts. They are internal sources and external sources. Then what is internal sources? Internal sources of funds are those that are generated from within the organization. For example, collection of receivables, disposing of surplus inventories, etc. The internal sources of funds can fulfill only a limited needs of the business. And the next one is external sources. External sources of funds include those sources that lie outside an organization, such as suppliers, lenders, and investors. When large amount of money is required to be raised, it is generally done through the use of external sources. Besides these, external funds may be costly as compared to internal sources of funds. Issue of debentures, borrowing from commercial banks and financial institutions, public deposits, etc. are some of the examples of external sources of funds. And these are the main classification of business finance.
So students, I hope all of you understood the concept clearly. And please note that the notes of the lesson and test paper are also attached along with the class. Make use of these available materials. Study well and attend the test paper without fail. That's all for today. Thank you.